another Sunday morning in beautiful Seattle, Washington. How are we doing today, Patrick, down in LA? Hey, Patrick, hold on. I got to do that little setting thing that we ran into in pre-production. Now we can hear you.
Okay, yeah. So, yeah, it's another glorious day. It's a beautiful day here in Greater LA. Welcome everybody to the show. We got an impressive lineup for you today, and can't wait to get started.
All right, Patrick. So let's get into it without further ado. Let's get into what we wanted to share today. Now, last week, I think we talked about Marcus, right? We
Yes, we did.
we talked about Marcus, and we compared a market, kind of money market account,
Yes,
and compared it to some ETFs. So,
yes.
staying along those lines, Patrick, we're gonna focus in on what is the Dow, and then we're gonna compare the Dow to the S&P. But oftentimes on CNBC, you see the Dow, the Dow, the Dow. Then they talk about the S&P and the Dow and the S&P. Let's share with our audience what's the difference, and let's go over the performance of the two of those. All right.
Absolutely.
All right, Patrick. So take it away for us, please.
Okay, so the Dow Jones Industrial Average, which was composed of 30 stocks, constructs a price weighted index. So stocks that generally have a higher price per share tend to influence that uh, index a lot more than, let's say, a market weighted index such as the S&P, where price really does not matter that much. It's the number of shares multiplied by the price of the share, by the price of the stock. So anyways, I'm going to briefly talk about the difference between a price weighted index and a market weighted index. So if I may share my screen. So just give me one moment. I'll get to the screen right quick. So the price weighted index is going to blow this up so our viewers can see this.
Yeah, and it looks like you are on Zacks. That's a really good analyst website.
Yes. Yes. So essentially, here, no, Zacks is very prolific in the financial world, and I highly recommend it. It gives you good analysis of the various indexes, market commentary, and the various stocks and earnings that are coming up. But anyways, the Dow Jones Industrial Average is an industrial component of averages compiled by the companies which publish the Wall Street Journal. The industrial average has 30 stocks. The founder, Charles Dow, began it in 1896 with 12 stocks on the New York Stock Exchange. And then in the late 20s, it expanded to 30 stocks. And only General Electric is the remains of the original 12 Dow Jones Industrial Average stocks from 1896. Now, a price-weighted index is what the Dow Jones is. So higher price stocks like IBM have more of a bearing on its scale than lower price issues, as I was briefly describing earlier today. Such as a one stock increase in a lower price stock can be offset by a $1 decrease in a much higher price stock, for instance, even though the cheaper stock had a greater percentage gain. But right now, until 1999, it just mostly consisted of New York Stock Exchange listed issues, whereas now it has a handful of tech oriented stocks that are from the NASDAQ. And I'll go over that a little bit later on. Conversely, a market capitalized index such as the S&P, created in 1957 by Standard & Poor's, essentially has a number of stock components such as industrial, energy, healthcare, utilities, and telecommunications. And it's a market-weighted capitalization. So it's basically determined by the price of the stock times number of shares outstanding for each component. And essentially that does weigh price as a major consideration in valuing the S&P 500. I think the S&P 500 is a better barometer of the health of the market because it has 500 shares, so you get much more diversification. It includes the all of the Dow 30 because the Dow 30 is a generally a large stock index, and it talks about it encompasses the market weighted components of the S&P versus a price weighted. So I think you're going to get a better valuation of the market as a whole. I want to show you the 30 stocks that make up the Dow 30. So here you can see the various components, such as it'll have American Express, Amgen, which are some of the tech stocks, Apple, Boeing, and so on and so forth. But again, a company, let's say like Goldman Sachs, will have an outsized influence on the price of this, on the value of the Dow Jones Industrial Average versus what Merck will do, even though Merck is probably a larger company than Goldman Sachs. So here are the Dow 30. Just kind of slowly go through them.
Got a notification at the top of the screen there, Patrick.
Yep. Let me see if I can. Oops. All right, there we go. So again, I'm just going to go through the 30 stocks here. Can everybody see that? Can you see that?
I can see that. I'm just looking at the stocks.
Yes.
In the Dow 30. And I'm looking at some consumer staples.
Yes.
Like the Johnson and Johnson, right?
Yes.
And not sure where I would put 3M, but Procter and Gamble. There's another consumer staple. And then
I would say 3M would be industrial.
Yeah, 3M industrial. Look at Microsoft. There's a tech.
Microsoft is obviously tech company.
Nike is a retailer. Travelers, insurance, and United Healthcare.
Yeah, Travelers is obviously financial. United Healthcare.
Salesforce Tech, Verizon Communication. I think Visa is considered a tech, even though it's a financial, but I think it's considered.
Yes, might be one of these so-called fintech stocks.
Yeah, it's more of a fintech.
But a large cap version of a fintech stock.
With Disney and Dow Chemical Company.
Yes.
So really huge big industry here. So when you buy the Dow Index, you're buying all of these companies in one shot. And then go ahead, Patrick, go ahead.
Exactly. And then, as I was saying, the S&P 500 will include all 30 of these stocks, since these are such large companies, and the S&P 500 index, as I was, to reiterate, is a market-weighted index. So these are large companies that will be in part, as I was saying, part of the S&P 500.
So I'm curious, Patrick. I'm curious. I see go down, please. I see
Yes,
American Express and I saw Visa.
yes,
Both of those are there, but
yes.
MasterCard, which is huge, is not there, or at least I might have missed it.
Now, Mastercard might not be there because even though it is a large company, and it possibly may be larger than some of these um, other companies that are in the Dow 30. Um, Visa and American Express have a longer period of being a large cap, being a bellwether in their field.
Okay, all right, but yeah, the biggest
Other
companies certainly in the United States, the Dow. So I think oftentimes new investors they do not realize when they're looking at CNBC and people are looking at the Dow is up, the Dow is down, or when you're looking at NBC News or ABC News and they're saying the Dow is up, the Dow is down. We're only talking 30 stocks.
You're only talking 30 stocks, and I mean, sure, the Dow 30 stocks will move in tandem with the market much of the time. There's generally a high correlation between the broader market and the Dow 30 in terms of performance. But you'll see a decoupling
Right.
often,
So
once in a while.
certainly a difference between the Dow and the S&P 500. These are encompassed or encapsulated, I should say, in the S&P 500. But
Yes.
and some of these are encapsulated in the NASDAQ, right? But
Yes.
it's good to know what these stocks actually are. It's good to know that Apple is there and Boeing is there and Caterpillar is there. It's good to know so that if one of those stocks like Home Depot has a horrendous session, then you know it's affecting the Dow.
Yes.
But we say that it's price weighted. So just from a price weighted component, how would like a Boeing or a Home Depot affect the Dow there, Patrick?
Well, as I was discussing with any kind of price weighted index, the Home Depot, Boeing, or Goldman Sachs here, because their price of stock is so high as compared to, let's say, Apple or compared to Intel Corp, they will have an outsized influence on the performance of the Dow.
Okay.
Because it's very price per share sensitive.
So
Whereas,
just to make the point,
yes,
the way of the high price, I wouldn't say the large share price companies, the way the Dow goes. So the higher price share companies are going to have a bigger effect on the performance of the Dow.
and I think that's why you don't see companies like Amazon, which is around $3,200 a share to $3,500 a share. It trades. That's not in the Dow.
Gotcha.
Or Warren Buffett's Berkshire Hathaway. You're talking about a stock that's over $200,000 a share. If that were in the Dow, I mean,
none of these would
Dow
matter. None of these would matter if that was there, right? This would be like
exactly.
a half a percent, and everything would be Berkshire Hathaway, right?
So if a company, let's just say, has a price per share of about $700 or $800 a share, and they want to split the stock, and it's a large cap stock that's a leader in its field, then that will be a very likely candidate in a future re organization of the components.
Okay. All right. So
You know, when the people behind the Dow Jones Industrial Average reevaluate the components of these companies.
okay. So just giving you some kudos on that, Patrick. Good job going over the Dow and explaining the Dow. And if you understood that, hit the like button, show some support. Let's go to the next one. So we know what the Dow is. We know it's 30 stocks. We know what they are. We know it's price weighted. Now let's talk about the S&P 500 because S&P 500 is talked about quite a bit on CNBC.
Yes.
So those are the two you will hear: the S&P 500, the Dow, and the NASDAQ. Those are the three indices that are featured consistently on CNBC. So let's go. Let's go S&P 500 now, Patrick.
Okay. So I'll go back to the Zacks description here. And the S&P 500, as I was introducing it earlier today, is a market capitalization index. So in other words, the index multiplied by some divisor essentially considers the market weight of the top 500 companies that are traded on the American exchanges, and the top third of the S&P 500 has 166 stocks that account for 75% of the index. So you're talking about roughly 60-70% of the entire market capitalization of the U.S. exchanges. So when you say market capitalization, that's essentially the price of the stock multiplied by the number of shares outstanding. So the price of the stock has little to do with if you're just considering the price. Unlike the Dow Jones Industrial Average, will have little to no effect on the index of the S&P 500. So you're essentially talking about, again, the market capitalization of the top 500 companies. And because it has a lot of technology in it, and generally higher growth companies than maybe the Dow Jones Industrial Average, even though all 30 Dow stocks are within the S&P 500, I find that the S&P 500 actually outperforms the Dow, believe it or not. And I'll go to this screen here. I'll blow this up a little bit if I can without distorting it. I think I am going to distort it, unfortunately.
5-year chart, I see.
That's a 5-year chart of the S&P 500 versus the Dow Jones Industrial Average. The candlesticks here that I'm glossing over, this is the price performance of the Dow Jones Industrial Average over a 5-year period. This has returned 88.34% over a 5-year period, whereas the S&P 500 has gone to, performed 103% over the same time frame. So you're talking about a 15%, roughly a 15% better performance by the S&P 500 over the Dow Jones Industrial Average. And again, I think that's largely because it has more tech-oriented stocks in it. So you're going to have more of the semiconductor stocks. You're going to have more of the internet. You're going to have like Amazon. You're going to have Tesla. You're going to have NVIDIA. You're going to have AMD, Lam Research, many of the top performers in these markets. You're going to have other financials that are doing well in a higher interest rate environment than you will, say, the Dow Jones Industrial Average. You're going to have a lot of the commodity stocks, such as Freeport McMoran, that have done really well up until now in the S&P 500 that you might not have in the Dow Jones Industrial Average. Hence, the more impressive in performance between the two. Again, the blue is here is the S&P 500. The candlesticks here, and I guess the red, if you will, is only has 88% versus 103%.
Gotcha. Okay. All right. I was a little surprised by that. I would have thought that the Dow, being 30 of the largest companies in the United States, would beat 500 companies. I would think you would have some good and bad, and so the Dow, just having 30, would have 30 of the best and would smoke the S&P 500. But that is not the case.
No, because you're talking about, again, it's a price-weighted index with the Dow Industrial Average, and you have to be, there are more stipulations in joining the Dow as opposed to joining the S&P 500. See, I find that the S&P 500 is more animalistic, if you will. There are fewer, there's less criteria to join the S&P 500.
Gotcha.
So that's why you don't see Amazon, Oracle, and some of the higher growth large cap stocks in the Dow Jones Industrial Average, because some of those stocks, like especially Nvidia, that's growing by about 100% a year, thereabouts.
Yeah.
And it's a large cap stock. You're talking about a $500 billion company.
Yeah.
Just the size of that company right there should be able to qualify for the Dow Jones Industrial Average. But because Nvidia is like $700, soon to be $800 a share,
yeah,
that's going to have an outsized impact on the Dow.
Gotcha. And one thing to note here is that when it comes to the Dow, S&P, all of these indices, they change over time, right?
Yes.
The governing body over those indices will move stocks in, or I would say companies in, and move companies out. So they do change over time. So.
Yeah.
All right, Patrick. So we have here a comparison. We see that the S&P 500 is actually performing better than the Dow 30. So let's compare them to the NASDAQ, because on CNBC, NASDAQ is king. So let's see how these two indices compare to the king.
So we're talking about a 5-year period here. And here, this time, the
blow
Dow
that
Jones
up some more. Let's just focus in on the end down there and blow it up a bit so that we can zoom in and see it on a.
Unfortunately, that might distort the chart.
Did we reach our limit? I think we may have reached our limit. No problem. Go ahead, Patrick. Just call out the numbers, please.
Okay, so I hope the audience can see well, and if they can, I apologize for that. But anyways, the Dow Jones Industrial Average is got an 88.34%, as I was showing in a previous slide. This is the NASDAQ National Board. So basically, it's the NASDAQ Composite. And that's got about roughly, I think, 1,000 stocks in it. And it's largely tech, and it's mostly larger cap stocks. But the growth has been very impressive that it's outdone the Dow Jones Industrial Average by I'd say 107%. So you're talking about 88% here with the Dow Jones, 195% with the NASDAQ composite. But the best of the breed in the NASDAQ 100 is has gotten you a return of 223% over a 5-year period. And the NASDAQ 100 and the NASDAQ composite also are market weighted indexes.
Okay, so we got, so the market weighted indices seem to perform better than this price weighted Dow, one. Number two, the NASDAQ 100 smokes all of them. Even though the NASDAQ is a great performer, but that NASDAQ 100, that's where you put your money in if you want that high, safer return. Do you agree with that, Patrick?
I would agree with that, and especially if you want to invest in the triple Qs, QQQ, that will give you the performance of the NASDAQ 100, which is this magenta line.
Gotcha. All right.
Or kind of or dark magenta purple, whatever you want to call it.
So in talking all of this indices talk, we talked the Dow, we talked the S&P 500, we talked the NASDAQ and the NASDAQ 100. Now let's talk about stock splits. And people get excited about when a stock is going to split and what does that really mean and how does that affect one portfolio. So let's talk about that, Patrick.
Okay, so a stock split essentially happens when a company decides to issue more shares, generally on a 2-for-1, 3-for-1, or 4-for-1 basis, and the price of the stock drops proportionally. So let's just say, for example, you have a company that has 100 million shares outstanding, and it's valued at $10 a share. So that's a $10 billion company. The company's growth prospects have been really good, for example. And let's just say that the company wants to do a 2-for-1 stock split. So what happens is that you will have you would trade in your 1 million shares that are outstanding. Those get canceled out and they get replaced by twice as many shares. So now we have 2 million shares outstanding, but the price of the stock would drop from $10 a share to $5 a share. Here, the market cap remains the same, but the holder of the number of shares outstanding is twice as much, and the price of stock gets cut in half proportionally. And the reason why stock splits occur is that number one, the people would be able to buy the stock more cheaply, and especially if you're trying to buy 100 share lots, which is considered a board lot. So, for example, let's just say you have in this example, a board lot, which is 100 shares. Prior to the stock split, 10 times 100 shares required you to spend $1,000 to buy a board lot. And now you got a stock split that has occurred. Here, you will only require to spend $500 a share. or sorry, $500 for board lot in the same company. It's just that they're 100, they're twice as many shares outstanding as a result of the stock split. Another thing, with another reason why you might have a stock split, is that maybe certain mutual funds have a theme, or certain ETFs have a theme, to buy shares no more value than, or buy shares in company no more value than $100 a share. So if you have a really good growing stock that's at $400 a share, and it does a 4-for-1 stock split, then you're going to have shares valued at $100 a share with 4 times as many shares. So then that mutual fund could also get into it. It's easier to do financing, among other reasons. So that's why you have stock splits.
Gotcha.
So I'm not sure if the viewers have any questions about how a stock split occurs and why it occurs. And
Well, I think you just did a good job describing that, Patrick. Before we go into our pick here, yeah, a stock split's what it is. It doesn't change the market capitalization. It just splits, reduces the price of the stock. So if a stock is $100 a share, and you have one share, stock is now $50 a share, and you have two. It's the same value. It's like instead of having $1, having a dollar bill, a 4-for-1 stock split will give you 4 quarters, but it equals to $1. That's all a stock split is. So now you're trading quarters versus trading dollars. So this, a share, you don't have to pay $1 for shares. You pay quarters for shares, and you have 4 of them. So I think you did a good job describing that. And I think you did a good job also explaining why on the Dow, which is price weighted, the price of that underlying would make a difference because it's price weighted. But from a market capitalization standpoint, it wouldn't matter because 4 quarters equals $1 and $1 equals $1. And the index is based on the market capitalization, which is $1. So it's the same thing, just to kind of break it down. If someone wants to hear it in layman's terms, you would agree with what I just said, right, Patrick?
Yeah, that's a great analogy.
Yeah. I try to, describe that. Like I tell my kids, a stock split. If you have a pencil, one length, you break it in half. You have 2 pieces of a pencil, but it's the same length. It may not be usable, but it's the same length, right? You want the length. But it's $1 versus 4 quarters.
You're doing a change for $1.
Yeah. So, okay. So that's what a stock split is. And we went through market capitalization versus price weighted, price weighted versus market capitalization weighted. I think we really went into that in a lot of detail. So let's talk about our pick, our stock that we talked about a week ago, and we're still talking about it this week because all of the hype and news around it. And what is that, Patrick?
This is
NVIDIA. We're talking NVIDIA.
time. NVIDIA was about $712 a share. I think it closed up on last week, Friday. This latest close, it went up to $745 a share, which represents maybe a 3 to 4% increase in the price of the stock in the last week. And the reason why the NVIDIA has done so well this last week is you had 2 analyst upgrades. For one, Piper Jeffries out of St. Louis, very prominent money management firm, has increased its target, I think around from a low sevens or mid sevens to $859 a share. So they expect that to occur within the next year per share. And Bank of America revised its previous target from $800 a share, which was put in about maybe a couple of weeks ago, to $900 a share. And that's to occur within the next year. These are very influential money management firms and investment firms, at least the investment arm of Bank of America. And the stock has really rallied because of that. A lot of excitement, but that's amid the stock split that's to be set July 20th later on this year. So that's less than a month. You're going to have 4 shares of new for every 1 share of old.
Yeah, 4 for 1 split.
Yeah, 1 split.
4
and
for 1.
as a result, it would be able to go into more indexes, perhaps, maybe even the Dow Jones, because it will have less of a price influence on the Dow Jones Industrial Average. Just think of that. The Dow Jones is very, very widely followed. So if NVIDIA goes into the Dow, wow, that'd be something.
Oh, that would skyrocket this NVIDIA even more. Because you have all of these institutional companies and retail investors, which retail investors are mom and pops like we are, buying indices, like buying the Dow, buying S&P 500, buying the NASDAQ, because it's a relatively safer bet than buying an individual stock. You're buying diversification and buying the indices. So, yeah, that would be huge, Patrick.
And it would just give the current stock price more validity. People won't be saying, "Oh, this is," they would be saying that it's more fairly valued, as to some who might say it might be overvalued. But what's more is that there's growing confidence that NVIDIA will close on a very, very strategic takeover of another chip producing company called ARM Limited. Conglomeration of companies in the high tech, in the semiconductor space, based in the UK, offers its chips and chip servicing in mobile phones, tablet computers, and for chips in smart TVs.
Wait a minute, Patrick. Could you go back? You cut out in the beginning about NVIDIA.
I'm sorry.
Can you repeat why ARM Holdings is important to NVIDIA?
Yes. Well, NVIDIA wants to get a foothold, or maybe even a stranglehold, in the portable PC, the portable tablet, and the other handheld devices. You want to get into that market. ARM Limited, which is a British company, is a British semiconductor company, which is more or less a conglomeration. But anyways, it provides services to mobile phones, again, smartphones, tablet computers, smart TVs, and other everyday use devices.
Look at that, 160 billion chips.
Yes, have been made for various devices based on designs from ARM, more than any other company.
Yeah, so all of those TVs and computers and phones that are made based on the design of ARM, they have to pay ARM a licensing fee to use
Yes.
that architecture. And NVIDIA
Yes.
is about to buy them, in the process of buying them. But go ahead,
Yes.
Patrick.
So, anyways, as you see right here, the I'm not sure what this would be in U.S. dollars, but I'm assuming this to say 100 yen equals a U.S. dollar. This is as of 2017, anyways. We're talking about a company that has over $1 billion in revenue. So it's rather larger cap. It's mid to large cap. This ARM Holdings. And again, this NVIDIA wants to expand its user base from large desktops and laptops, because NVIDIA is known for gaming mostly, and it's very, very difficult to get their latest generation of their gaming card. I know I experienced that firsthand, because when I bought my computer fairly recently, the build had been delayed because they couldn't find the appropriate graphics card. And again, that's NVIDIA. And everybody gets camped out in all of these various computer stores to buy an NVIDIA chipset card. So now they're expanding not only into that field, but they're expanding away from that. They're diversifying their interests into not only data centers, AI, electronic vehicles, but NVIDIA is interested in getting into the tablet market, into the portable PC, into the into smartphones and other appliances that people use every day.
Yeah, and this takeover, this purchase of ARMS. Oh, I say ARMS is ARM.
ARM Limited.
Yep, is the way they plan to accomplish it. So in accomplishing that, Patrick, go up a little bit. I want to see further down on this Wikipedia here on ARM. Just a very impressive acquisition that NVIDIA is in the process of doing. And this has been in the work for about a year. So they're in the second year of getting all of the regulatory hurdles and stuff that they have to accomplish to be allowed to take over ARM, because, you know, this whole antitrust stuff and all of that you have to do when you're purchasing such a company of this nature. But if NVIDIA accomplishes this acquisition, it's to the moon for NVIDIA. So this is a big catalyst for that stock, you know?
Exactly.
All right.
And there's growing confidence that this deal will be completed.
Do you have a 5-year in closing? Let's show a 5-year of NVIDIA. It'd be interesting to see a 5-year chart on NVIDIA. And so this is the company that Patrick and I both own here. So we're big holders. I even have long call options on NVIDIA. So let's take a look at it, Patrick.
So when essentially 5 years ago, it was roughly, I'm not sure, I guess that would be $100 a share. But then the explosive growth has just been amazing. That's been pricing the stock. I mean, you get a little bit of volatility here. And then, let me see where that is. And this is 2020, and you got a little bit of volatility here, but NVIDIA has just completely grown and grown and grown, had a little bit of consolidation here, and then it's broken out again.
Yeah, and we're talking about the Internet of Things, right? So when you're talking 2017, 18, between 19 and 20, I mean, they were flushing out the Internet of Things. Is it really going to happen? 5G hadn't rolled out yet.
Yes.
So now the 5G rollout is happening. The Internet of Things appliances are getting more connected. Wi-Fi 6,
EV
and all of that.
and
Crypto.
cryptocurrency. Yes.
So Nvidia to the moon. That's all. We're real big on Nvidia. Certainly, you will want a pullback to get in. You would not want to get in at these levels. The Bollinger Band can help with that. Super, we need to do a show on the Bollinger Band so that people can know the entry point. I know we have touched on it, but we should go do more.
Yeah, as a refresher.
Yeah, more refresher, in-depth, looking at the Bollinger Band, just very in-depth to see when to get into a position like NVIDIA. But we're certainly big on NVIDIA. And
yeah, I mean, right now it's just kind of really
at the top of the Bollinger Band there. Ouch. Certainly will want to get in NVIDIA at the bottom of the Bollinger Band, but I doubt that you're going to catch NVIDIA at $459. Can you point to it, Patrick? And 72 cents. You're not going to catch NVIDIA at that price.
No, you're not.
But it's off to the moon. So, all right, Patrick, let's unshare. It'd be good to see you again. We haven't seen you in over 40 minutes here, man.
Yes.
So it'd be good to get you back here, Patrick. And so I hope the content that we provided today made some sense. Let's see if I can get you back up here, Patrick. You there, Patrick?
I am.
Okay, let me get you back in here. Make sure that we're back together. That's kind of what we wanted to share today. We wanted to just really go more in depth to what the Dow is. I mean, I encourage everyone to look at CNBC, so whether it's Squawk Box or Mad Money or Fast Time, all of the different CNBC shows from 3 a.m. Pacific time till about, that's super, Patrick, about 4 p.m., 3 p.m. Pacific time, which is
4 p.m.
Yeah, about 4 p.m. So you have a whole
between 3 and 4 o'clock.
You have a whole slew of financial shows on West Coast time. Would be from 3 in the morning to about 4 in the afternoon. All CNBC, financial stock stuff, and it's consistent. Dow. So one, Charles Dow, he invented it. Two, late 1800s, he invented it. Started with 12. 3, took it up to 30 around 1929. Only one still exists, GE, out of the original. It's price weighted, and it's different than the S&P 500, which we went in great detail showing. And then, in looking at that, is it better than the NASDAQ, that the S&P 500? Is it better than Dow? Is it better than the S&P 500? Is it better than the NASDAQ? Because CNBC always talk about those two indexes as well. And so we just try to go more in depth, just staying with the staple traditional indices without going into ETFs. So I think that kind of encapsulate what we plan to do today. Patrick, anything else to add to that?
No, I think we've pretty much encompassed everything I wanted to talk about.
Yeah, and so
this session.
Yeah, for sure. So that's why if the content was helpful.
Yes.
If you learned something, please share. This is all about sharing with your friends and family, particularly with your kids. I really would like the kids to get more interested in investing. And so it'd be
exactly
good. Yeah, I would really like that. The younger generation. So I mean, that's pretty much it for today, Patrick. We will be in Las Vegas. I will see you on Thursday, Patrick.
Yes, I'll be there too. Looking forward to that.
Yeah, and then we got a lot of business to do out there. We're going to look at some real estate there.
Yes.
We will be shooting the show next Sunday from Las Vegas. And so
Yes.
I'm going to be coming over to your fancy luxury hotel to check you out in the wind, Patrick. And we'll catch up. So I'll see you on Thursday in Las Vegas, and look forward to seeing us on the Bet Out of Debt show next Sunday from that location. So that is the Bet Out of Debt show for today. I hope you enjoyed it. We call this show the Bet Out of Debt show because when you place a trade, it's called placing a bet, and hopefully it's a winning one to keep you out of debt. And like always, keep investing, and we will see you next time. Goodbye.